Learning Objective 3, Communicating Through Financial Statements. We discussed that different business activities produce assets, liabilities, stockholders' equity, dividends, revenues, and expenses, and that the first important role of financial accounting is to measure the relevant transactions of the company. The second vital role is to communicate those measurements to the outside people of the company. The primary means of communicating business activities is through the financial statements. Financial statements are periodic reports published by the company for the purpose of providing information to those external users. We got four primary financial statements: the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows. Note, each one of these financial statements must be presented or computed in this order. The income statement is always first. Let's look at the income statement. It's a financial report or financial statement that reports the company's revenues and expenses over an interval of time. Basically shows if the money is generating enough revenue to cover their expenses. The next formula that you need to memorize, remember the first one was the accounting equation, assets equals liabilities plus stockholders' equity. The next one is revenues minus expenses equal net income. So on your income statement, you're only going to list your revenue accounts and your expense accounts. So note, for Eagle Golf Academy, we had service revenue. We're going to list that as $7,200. And then we have all of our expenses that we list individually and get our total expenses. The one thing to note here is on an income statement, you do not represent expenses with a minus sign. You just have to know, based on the formula right here, that revenue minus expenses equals net income. So you'll never put minus signs on the income statement. This is important to note as well. In Connect, you never put minus signs on the income statement. So then to calculate your net income based on the formula revenues minus expenses gives us a net income of $1,200. Remember that number of net income, $1,200. The next financial statement is our statement of stockholders' equity. This is a financial statement that summarizes the changes in stockholders' equity over an interval of time. Stockholders' equity has two primary components. You've got common stock and you've got retained earnings. Remember, common stock is the amounts invested by your stockholders, the owners of your company. Retained earnings is an internal source of equity. It represents the cumulative amount of net income earned over the life of the company that has been kept or retained in the business rather than distributed to stockholders as a dividend. Think about reasons why you would want to retain money in the business. If you're wanting to grow your business, it would be better to be able to pay for it out of the business versus having to go back to the bank and creating another liability. Or if you're a service-oriented business and you have equipment, that equipment eventually is going to have some repair maintenance needing to be performed. So if you've got the money retained in your business, you can cover these unforeseen expenses. So stockholders' equity is the two components, common stock and retained earnings. To prepare a statement of stockholders' equity, you need to memorize this format. Hint, this particular question, you will be asked to prepare a statement of stockholders' equity on your midterm exam. So for the statement of stockholders' equity, you have the two columns represent the two components, common stock, retained earnings. The third column, total stockholders' equity, is the summation of your common stock and retained earnings column. You always start out with a beginning balance number, and in this particular case, since we're starting new, we have no beginning balance. The next row will always be issuance of common stock. And note, we issued $25,000 in common stock. We sold 1,000 shares at $25. The next row will be to add your net income for the period. And here's that $1,200 from the income statement that I told you to remember. You're going to bring that number down from your income statement under your retained earnings column in the Add Net Income row of the statement of stockholders' equity. The next row is your less dividends. So we paid out $200 in dividends. Now this is different from your income statement. You do represent minus numbers or numbers that needed to be subtracted out as a minus in parentheses. Be sure to pay attention and connect as to what it's asking for, either a minus or parentheses. So then you add up your columns, $25,000 in common stock, $1,000 in retained earnings, add across, and we have a change in stockholders' equity of $26,000 at the end of December. And again, remember these numbers here as we move down into our balance sheet. The balance sheet is a financial statement that presents the financial position of the company on a particular date. The financial position of the company can be summarized with our accounting equation: assets equals liabilities plus stockholders' equity. So let's look at our balance sheet. On our balance sheet, we list our assets on the left-hand side of our equation, and our liabilities and stockholders' equity sections on the right. And in this case, we have assets of cash, accounts receivable, supplies, equipment, and other assets listed here. We add those up and we add up our total assets to be $40,000. Then we move to our liabilities. Note, liabilities are amounts owed to you. All liabilities are typically denoted by the word payable at the end of the account title. So we list our liabilities and add total liabilities up at $14,000. Next, we complete our stockholders' equity section, which is the common stock and retained earnings. And see these numbers here, they're brought down from your statement of stockholders' equity. So then when I add my $26,000 stockholders' equity to my $14,000 total liabilities, I get $40,000. In order to know that this financial statement is correct, the left side must equal the right side. If the two do not equal, then you have made a mistake somewhere up above in your income statement or your statement of stockholders' equity, and you need to go back and check those out and rework them. Another thing about the balance sheet financial statement is that it's at a particular date. What this means is it's only for a 1 month time period. Think about this. Cash really can be represented as your checkbook. Your checkbook is what it is at the end of December. For the income statement that's reported over an interval of time, now that was for the period ending, and it can represent multiple months. As you go throughout a calendar year, you're constantly going to be increasing your revenues and you're going to be increasing your expenses, versus on the balance sheet, whatever is in your bank account at the end of the month, it is what it is. So that's what the difference between interval and particular date. And lastly, we have our statement of cash flows. This is a financial statement that measures activities involving cash receipts and cash payments over an interval of time. You can classify all the cash transactions into 3 categories that correspond to 3 fundamental business activities: operating, investing, and financing. Operating cash flows include your cash receipts and cash payments for the transactions involving revenues and expenses. So all of these are going to come from your income statement, the revenues and expenses. Your investing cash flows include cash transactions for the purchase and sale of investments and productive long-term assets. So in the Eagle Golf Academy, that would have been when we invested in buying the equipment to get our business going. We're investing in our company. Financing cash flows include cash transactions with lenders and with your stockholders. So all 3 of these are pulled into the statement of cash flows, and you get subtotals of each category to represent your cash at the end of the period. And our check figure here is we have cash at the end of the period of $6,900. We need to go back up to our balance sheet and make sure that it balances to our cash, a number on our balance sheet, and it does, so we know our financial statements are in good shape. And then lastly, Pay attention to the links among the financial statements. You can see based on illustration 1.9 how your income statement flows into your statement of stockholders' equity, which flows into your balance sheet, that then flows down into your check number for your statement of cash flows. And to wrap up Learning Objective 3, we have other information reported to outsiders. We've got this thing called a management's discussion and analysis, or an MD&A, which includes management's views on significant events, trends, and uncertainties pertaining to the company's operations and resources. This may be where you as management want to include a note of some future growth that you're projecting that may not be presented in the financial statements but would be important to investors. And then the notes disclosures offer additional information to either to explain the information printed in the financial statements or to provide information not included in the financial statements. And what this can mean is if you look at the balance sheet, let's go back to the balance sheet. If you look at the balance sheet, each one of these all you see on the financial statement is a number. Think about accounts receivable, $2,700. Do you typically just have one customer? No. You're going to have multiple customers that you may allow to charge. Accounts receivable, you may have something that you need to make a note about at the bottom of your financial statements to make it stand out a little more clearly to investors that's not seen and just by looking at the total on the balance sheet. So that's the purpose of a notes disclosure.